Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to talk about evaluations of stocks and why you should do them actually yourself. So because when we look at what we get from specialists, then we get the target price and we get a recommendation whether or not we should sell or buy a stock. But the thing is that we don't know how those specialists determine the target price. So most of the time, they say that it is based on the average forecast of multiple analysts that are following the company, but you don't actually know how many analysts of the specialist company is following the company that you are interested in, and if there are actually multiple analysts. So for me, I think there is most of the time only one person, and in the best case, there are multiple. And then when they do their evaluation of the stock, then it is based on earnings forecasts and assumed valuation multiples for the company. So I will talk later about the assumed valuation multiples. The earnings forecast, okay, you need to do that, that's for sure, but the assumed valuation multiples, I don't like that too much. And then there is another big but, and that is that all those forecasts and assumed valuations are not made by you. So you don't know what they are and you don't know what the margin of safety is that they use to do the calculations. So when you see a target price of a specialist company, a bank or a broker or something else, it doesn't matter, you don't know what lies behind it. So, okay, you know the numbers of the company itself, but then what they do with the numbers, you don't know. And then another thing is that when you look at some of those websites from those specialists, and I give the example of UBS Neo, so the investment bank of UBS, it's open access, so it's really great. You can look up all the target prices and the recommendations of the stocks and how it how they went on it in the past. So it's really great, the information that you get, but you don't know how they calculated the price actually. So when you look at the site, you can look at it for hours and hours and hours. You're not going to find anywhere how they calculated things. So that's really annoying. And another thing is you get a lot of disclosures and disclaimers. I know it's the right thing to do because they need to cover their asses, of course, because it goes it deals with money. So when money is involved, you need to have disclosures and disclaimers. So you can read this one. So they worked for the company in the past 12 months. Again, we worked within the past 12 months with the company or affiliates with the company that we did the analysis for, and three more others. And in the end, I have disclaimers too. I say this is not financial advice. This is just my personal opinion, the things that I am interested in and I make videos about. So I always put this here in the corner of my slides because when money is involved, you need to do that. Money, yeah, it's an important thing in the world, so I need to cover my ass as well. So I put the disclaimer here, and yeah, the things that I am interested in, I make videos about, and it's up to you to look at them and make up your own opinion and do your own research. Really important. And the same thing goes about the things that the specialist give us, we can look at it, but then we have to make up our own decision. And then when they give you recommendations, you can most of the time have 5 categories, 2 of which are less common to give, and then you have 3 others that are most of the time used. So the first one, which is actually not that much used, is a strong buy recommendation. Most used is actually the buy recommendation, the hold recommendation, or the sell recommendation. So these 3 are the most common you will see. And sometimes you will see the other names that are behind it. So a buy can also be depicted as outperform or overweight. Hold can be neutral or equal weight, and sell can be underperform or underweight. So in general, they say buy the stock, hold the stock if you have it, of course, or sell the stock, or reduce your amount of stocks in the company. So if you like the company, you can still be invested in it, but at least reduce your stake in the company because the specialists think that it is going to underperform the market, so you shouldn't be exposed as much as before. And then of course, one that you see less often is strong sell, just like the strong buy. And another shortcoming then is that nowhere on the website of those specialists you can see what the time horizon is of these recommendations that they give. So I call those WWDK, and that stands for, well, the time horizon of these recommendations we don't know. And if you don't know it, you shouldn't look at it as a fixed thing. Because let's look at some of them from the past week. So Friday and Monday, this Monday. So Friday the 15th of March, we had one from Barclays about Geberit. They increased the target price from 360 to 400 Swiss francs, and they gave a recommendation to underweigh the stock. So you see, there is almost an increase of more than 10% for the stock, and still they say that you need to sell. And that's actually quite normal when you look at the price that they have right now. So at the end of the trading day of the 18th of March 2024, Geberit is trading on 527 on the 6 right now. And so today they lost almost 2%. And it's not normal that it's not abnormal that they are dropping a bit, because most investors don't like when a company gives a forecast for the future that is on the low end. So a lot of investors are a bit, unhappy. Although they have still a high profit margin and they will continue to have it in the future as well. And they are going to pay out more dividend than the year before. So from 2022 to 2023, their dividend is increasing, and the dividend from 2023 they are going to pay it out this year, of course. So it's always what they earned in 2023 they are going to pay out in the next year. So the profit that they made in 2023, we are going to receive that now as a dividend in 2024. And then we can go to the next one from research partners. So we already have Barclays, now we have research partners, and they gave a target price for Peach Properties of 15 Swiss francs. So it dropped down from 27 to 15, and still they give a recommendation of buy because the price right now is 9. So we have an upwards potential of 66% for this company, Peach Property. But although they have a higher rent intake on their real estate portfolio, they still are in deep red figures, but mostly actually due to the valuation losses of their real estate that they have in the portfolio. So that's a real bummer for Peach Property, and a lot of real estate companies have that problem right now. That with the higher interest rates and also the valuation losses that they have, that they are performing less. So when you look at Vici Properties, realty income and stuff, they are dropping like stones right now. And in the case of Vici Properties, the price to earnings ratio is really interesting right now. For realty income, it's still not great. It's that's the least I can say, but still, not financial advice. It's only the things that I have in my head. So Vici Properties, I think it's around 11, and realty income it's around 40 the PE. So Vici Properties looking way more promising for the future than Vici Properties, than the realty income, but that's just based on the PE ratio, and I will come to that later. The PE ratio is not the only thing where I look at. Certainly not. Then we have UBS. I can't leave UBS out, of course, after I talked about them earlier, and that was certainly not to diss UBS about that. All the specialists do it when they give their recommendations and their target prices. They all have disclaimers, they all have disclosures. So UBS is just like all the rest. They are not worse, they are not better, they are just the same. And now they gave a target price for Sonova of 260. It went up from 225 to 260. So a nice increase, in fact. But still, they give a sell recommendation because the price right now was, yeah, almost 8% above what they had as a target price, and now it dropped a bit, so -2.5%, and now the target price, the current trading price is 268.30 Swiss francs, so only 8 francs above the target price of UBS. So here the price is more or less in the same proximity. So yeah, they give a sell recommendation, but once again, what is the time horizon? If you look at Sonova, they aren't a bad company at all. So the only thing that doesn't speak for them is that they lost a contract with Costco in the United States. So that is a really bad sign. And all the rest, it's just due to currency problems. So they have less earnings, but if you take out the currency problems, they still had higher earnings with 1.6% increase in earnings. That's not a lot at all, I know. And of course, their profit also was less due to the currency problems. So is this going to last? We don't know. We have to wait later on this week. The SNB is the Swiss National Bank is coming together and deciding on the future interest rate here in Switzerland. So if they drop it with 0.25%, what they actually should do, but they probably won't do because they make the same mistake as the US and Europe. They are, yeah, they are waiting and waiting and waiting, but the numbers are skewed due to the fact that the interest rate that is there is way too high. So the inflation is staying up because of the interest rate that is up. So they are actually waiting for themselves to make a move. And in the past, the SMB was really good about it. They were the first ones to stop with the increases. So I hope they are also the first one to to start with the decreases of the interest rate. And then from Monday, we had the one from Goldman Sachs concerning Meyer Burger, and there the target price went from 0.38 to only 7 cents, and the recommendation was neutral. But today, yeah, there was a big drop. And if you follow the news about Meyer Burger, you know why. Because they announced a capital increase to move the activities to the United States, and the capital increase is going to, yeah, they are going to give out 20 billion shares, a little bit over 20 billion shares for 0.01 Swiss franc each. So yeah, they dropped from where they were quite significantly. So yeah, they went down today quite hard. So a loss of almost 28% today, and that's quite normal with such news hitting yeah the stockholders this morning. It's quite hard. So actually, they are saying we were wrong, and now we need to turn the table completely, move to the US with our activities to see whether or not we can succeed there. It's not for certain at all. So my recommendation would be to sell. If you only have a few Swiss francs left, you can hold on to it, but yeah, you will need to put down extra cash at the moment that you if you go along with the capital increase, and if you don't do it, then yeah, yeah you are actually increasing the chance that Meyer Burger is going to go down completely. So if you believe in the company that they can do it, you should go along in the capital increase. And if you don't, sell your stocks to somebody who does. That's the point. Julius Baer concerning SFS, so a metal company, target price from 105 to 120 Swiss francs, so slight increase of a little bit over 10%. And the recommendation is hold. The price right now is 116, so yeah, it's near where their target price is, so hold isn't that normal. And they have more revenue as FS, but the profits don't rise as much as the revenue. So yeah, it's it's a difficult thing as FS. I don't follow the company that well, so I don't know the numbers that well as well. But when you see the revenue rising for a metal company and the profits don't rise as much, there is something else going on, because normally they have the equipment, they have the people working there. So when they have more revenue, actually the profits should increase more. So when I see that for a metal working company, I don't like that. Maybe they are investing more in the future, that can be, but I don't know. So not financial advice at all. And then the last one, again, one from UBS. Yeah, UBS is the biggest bank, so they have most of the stocks under their supervision. So they they gave one for Logitech as well today, and the target price went from 53 to 58, so well below the current price of 78. But if you look here, there was a drop of 7% today, so it was much higher at the beginning of the day. So UBS also not scared of really putting out a lower target price than what it is currently trading at, which is really nice of UBS. But there was news today, and that is that the chief financial officer leaves the company, is going to leave the company, and he was only working there for about a year. So yeah, the market isn't taking that up lightly as well. So that's why Logitech dropped completely today. So I'm just going to remember you about the rules that you have as an investor in stocks. And the first one is you need to understand the company. Then the second one is, does the company have a durable advantage? The third one is, do you like, trust, and believe in the management? So if you trust the management of Meyer Burger, you know what you need to do. And then the fourth thing is, do you like the price of the company right now? And important there is the considering the margin of safety that you apply to the company. And how do I determine the target price? Well, first off, I do value calculation using the financial reports, and I use the earnings per share, the price to earnings, and I predict the growth of the stock of the earnings of the stock, and therefore I use the Graham valuation. I know there are a lot of different formulas around. I use the original one, I use the renewed one, and I use my own one. And I definitely like my own one because with my own one I always have enough with the price to earnings ratio because I can calculate it then really fast in my head to make a distinction whether or not the stock is worth it to look at it further. And when it is, I will do this calculation completely correct and look at the numbers of the company the past 5 years and then try to estimate it for the next 10 years. And I do not use the multiples valuation model because looking at what the other companies in the same sector do and have as a PE ratio, that doesn't interest me at all. And when I'm interested in a stock that is in a sector, I want it to be different from the other companies in the sector, so I don't want to use the multiples valuation model, just so you know. Then another important one is the discounted cash flow analysis. So I don't use the dividend discount model, not at all. I'm a dividend investor, so I like buying stocks that give me a dividend. But if I can buy a stock that doesn't give a dividend and has a good valuation, I will do that for sure. And I don't look at the dividend as a decisive factor to buy a stock, yes or no. And a dividend discount model, okay, it is nice that I get cash back from my investment so that I can reinvest that cash into the same company or another company. And a lot of people say, yeah, that is not that good tax wise. I disagree on that because I look at it as a wage. So I own the company and they pay me to own the company. And when they pay somebody who works for the company, they have to pay taxes on that as well, on that wage. So when they want to pay me as an owner of the company, they should pay taxes on that as well. What I don't like about the taxes is that sometimes you have double taxation. So, for example, when you buy a French company, you have to pay taxes in France and then you have to pay taxes on top of it in Switzerland. I don't like that at all. And certainly not the fact that it's 30 and then 35%. So that's totally stupid. So they should do something about that. I like it when I buy German stocks. There we have an agreement, Switzerland and Germany. The Swiss don't pay the taxes to Germany, and the German people don't pay taxes on the Swiss to the Swiss government. They just pay taxes in their own country, and that's the way it should be. Double taxation is really stupid. And then you have the pure asset base ratio from accounting figures. I do it from time to time, but I don't think it's that important. So I don't use it to buy, but it's just nice to know for sure that you are buying something on the cheap. So if you look at that, the stock market does not care what the assets are worth when there is panic. Look at Credit Suisse. It was worth 48 billion and it was sold for 3 billion. Later on, only a half year later, UBS comes and they say, hey, we have so much profit on paper because we bought Credit Suisse really cheap. On the time, at the time that they sold Credit Suisse, the Swiss government didn't care. They wanted to sell the company Credit Suisse as soon as possible to UBS so that UBS could back Credit Suisse so that it didn't default. And that was really important. So sadly enough, the Swiss government didn't came up with the extra 20 billion to back up Credit Suisse itself, and they chose for UBS. But in the end, the stock market does not care what the assets are worth. So when you know what it is worth, you can only go from these valuations and this valuation and guess whether or not you are doing the right thing to buy it. But if it is getting really cheap, just like Credit Suisse, don't touch it anymore. And that's the next slide in my video. So do not forget the margin of safety. And what I most of the time do is I do my calculations, and when they hit 10% margin of safety on the Graham valuation calculation, then my recommendation becomes buy. So when I have money, I buy it. When it goes down to 20% margin of safety compared to the Graham valuation, I certainly going to buy it. And when it hits a 40% margin of safety, I'm going to buy a lot, as much as I can. And then my play money is most of the time finished. So for me, the story is over unless they hit 80% margin of safety, then I sell everything. At least I don't lose everything, but when it's 80% below my calculations, then something is really off. Maybe I'm completely wrong, and when I'm completely wrong, I need to sell. Sometimes I do it with a drop to 60%. So when it's going down even below 40%, and it's going towards 60, 70%, it can be that I already sell. But when it hits 80%, I definitely sell because I don't want to lose everything. So yeah, it can happen. It happened 2 times so far in my career. So as an investor, it's always a pity that it happens. But when you have the other way around, when it goes up 400%, you are not complaining. So it's all in your head when you are buying stocks that go down and they are really cheap. It can be that they are cheap because they are crap. And that's why you should always do the 3 points first to know that you're not buying crap like Credit Suisse. What is the time horizon for my recommendation? Well, it's always the long time horizon, and that means a minimum of 10 years, because that is how far I always try to predict the future earnings of the company. And that's my video for today, so thank you for watching. See you on the next video, and please hit that subscribe button. Also hit that like button, it helps out the channel enormously. So thank you, and see you on the next video. Bye.